purchasing power of the world's reserve currency, the US dollar, will decline substantially over 10 years. I've been saying 75%. My belief is if the US dollar declines 75% in purchasing power, that gold will maintain its purchasing power. So, at least in the nominal context, I expect the next 10 years to be very good for the gold price. That isn't to say that there won't be cyclical declines, that there won't be fluctuations in the price. But I believe roughly that gold will hold its purchasing power, while the dollar will lose 75% of its. For speculators, I think over time, silver and the silver stocks will do better. I also believe, for reasons that we'll go into, that copper will need to be rationed by price, beginning sometime around the end of this decade.
There still is, yeah. No, despite the macro backdrop or geopolitical
Right.
backdrop, which allow me a quick follow up on Saudi Arabia before we talk about perhaps what you love as well right now. What are you selling, perhaps? But Saudi Arabia, like how attractive as an exploration area is it right now, given especially the geopolitical backdrop?
I think it's quite attractive. I've always been attracted to the geology of the Arabian Shield. I had some very good luck on the west side of the Shield. I was early in the Centamin discovery. I was very early, 5 years early, on Nevson. I was early with Rick Clark in
Okay.
Sudan. So I've been very lucky on the western part of the Arabian Shield, the so-called Nubian Shield. And I always had an interest in the Saudi side. But until there was reforms in the Saudi mining law and also in terms of the licensing procedures by which foreigners might participate in Saudi Arabia, I was unable to turn that affection into investment. That all began to change 2 years ago. Two things attracted me. One was the evident seriousness with regards to the way that the Saudis went about changing the foreign investment protocol and the extraordinarily high caliber of the investors that were drawn to investing in Saudi Arabia. It's early on. My own experience, Kai, and your listeners are going to hate this. My own experience is that when the industry begins to get involved, grassroots, in district-wide exploration, it's usually as much as 10 years before they make profound economic discoveries. And as a 73-year-old, that's somewhat challenging for me. What my hope is that by contributing in the seed round to three different exploration companies, that I will get something resembling a discovery in a substantial shorter period of time. I'm also backing the prospect generators in Saudi. So what I'm hoping is that the companies that I'm backing end up with 8 or 10 concessions, that they do the preliminary work on them, and they farm most of them out so that the heavy lifting in exploration is done on other people's dimes, not mine.
Absolutely. I'm invested in Saudi Arabia as well, but it sounds like you're not really concerned about what's happening in the Middle East right now in general. Rockets flying and all of that, that's not impacting. It's just maybe timelines, perhaps?
Uh, I think right now I'd probably, for a whole bunch of reasons, have trouble investing in Iran. On the other hand, I don't know that my government would let me invest in Iran. I would love, by the way, to invest in Iran. I would love to invest in silver exploration in Iran. I'd love to invest exploring for copper porphyries. I'd love to invest in Zarafshan, the wonderful zinc deposit in Iran. But the circumstance may not be right even for the rest of my life. I'm really attracted to good geology, even if that involves not so good politics.
That's exactly the point. What are you going to do with that? Like, Iran is really difficult, but the opportunity is insane because it's so untouched, right? So maybe that's where the hate is right now. But you might get
And,
sanctioned.
who knows? It might be 5 years from now that the circumstance is very, very different. If the circumstance is different and the attitude of the mining and investment community hasn't changed, maybe this old man will get a chance to invest in Iran. I would love for that to happen. I've invested successfully in a lot of jurisdictions that were considered to be extremely politically challenged. I've made money twice in Sudan, a lot of money. And the best country in the world for me in terms of money in, money out has been Democratic Republic of Congo. No easy place. Um, I was in Peru literally as soon as the Shining Path were kicked out, uh, long before the currency was convertible, about the same time that the flak jackets came off. And I need to say, I had 24 very good years investing in Russia before I had one catastrophic year.
Yeah.
So I need to say, taking what are perceived to be political risks, where I believe the risks are less serious, at least less serious relative to other countries than they are, has treated me very well. Conversely, uh, I've experienced a lot of the negative result of political risk investing in countries that weren't perceived to be risky at all. My worst experience with political risk came in the People's Republic of California in 1980. I've also experienced real firsthand political risk in British Columbia and in the province of Alberta, where 15 years ago, when the natural gas price went up, the provincial government responded by doubling the royalties. That's nationalization. It's just nationalization done in English by white people.
Which makes it absolutely okay, of course. So absolutely normal. I was going to ask you, like, we've seen a bit of less, let's say, less love in the mining space over the last, what was it, 5 weeks now, ever since the beginning of March. I'm not even willing to call it the PDAC curse because there are other reasons for the drop. So I'm curious, like, is there less love out there now? Is that maybe a little opportunity? Is there a little bit of hate in the markets? I'm looking at the gold price. Oh, sorry, not gold price. Gold stocks and silver stocks.
If I felt better about liquidity in the US market, I would be buying the high quality small cap gold miners. The They have cooled off substantially. The gold quote has, of course, pulled off from what 5,500 to 4,700. By the way, that's irrelevant. Um, I've experienced so many 25% declines in my life that I think of a 10% decline as gold inhaling or exhaling rather than anything else. I feel very good about the gold price over the 5 or 6 year time frame. The consequence of that is that this hiccup is inconsequential to me. And I notice that the gold mining industry is sequencing in terms of market capital, not market capitalization, but rather multiples by size, which is to say that the biggest companies are enjoying the strongest trading volumes, hence higher share prices, hence a lower cost of capital. Um, that traditionally is a very good M&A environment. Single asset producers are rightly regarded as riskier than multi-asset producers. That discount goes away if a multi-asset producer takes over a single asset producer. And there's a lot of takeovers that are going to take place for synergistic reasons. The very recent takeover of G2 by G Mining, an amazing transaction done at a 70% premium, accretive to both companies, and even the acquirer shares went up in the aftermath of it. That tells you something about the opportunity that is present in gold equities markets now for participants who are rational and hardworking. I'm both rational and hardworking. My problem is I own a lot of this stuff. If you want to see a portfolio that is really strangely overweight gold, all you have to do is look at mine. Um, I may not be able to resist, but right at this very moment, Kai, I'm actually adding to my liquidity, which as recently as 3 months ago, I would have told you was excessive.
I was going to follow up on that because we briefly chatted before hitting the record button, and you gave me an opening to ask that question about the U.S. market and the private credit and the equity situation or private credit quality situation here. It sounds like it's giving you a lot of reason for concern here.
I'm not normally a near term guy, but I don't like the near term here. I think that this conflict in the Middle East, first of all, has of course damaged confidence. But you and I talked 3 or 4 months ago about the fact that I thought that we might be on the verge of a recession. I think we're in one now. I think we have to pay for this war. And I think if the war doesn't end fairly soon, like 2 or 3 weeks from now, that we're going to have a much stronger oil price shock than we already have. Simultaneously with that, there are real stresses in the private credit market. And there is higher near-term interest rate, which impacts the ability of businesses to access credit at any price, but particularly at a price they're comfortable with affording. Specifically, Kai, if credit concerns extend, and if the ma and pa investors who own high yield ETFs, which is a polite way of saying junk bond ETFs, begin to redeem, I think that there's a possibility, I'm not saying a probability, but there's a possibility of a real liquidity collapse, a real credit collapse, something on the order of 2008. I don't want the headline to say Rick Rule forecast 2008 style collapse, but even though I don't believe that there is a probability of this, which is to say I think it's a possibility, the consequences of it are severe enough that I'm taking precaution. The worst thing that happens is I go through this next 6 months with too much cash. I've committed worse sins than that in my life. I've been in the business long enough to know that the only thing that saves you from a liquidity crash is liquidity. If you have cash when those about you don't, or don't have the courage to use it, you can take advantage of the circumstance as opposed to being taken advantage of by the circumstance. This takes me back to the immediate aftermath of 2008, which was, of course, 2009, the single best investing year of my career. I had the cash, and because of my education, I had the courage to take advantage of that circumstance rather than being taken advantage of. And my building liquidity has everything to do with my nervousness about credit quality and my desire to take advantage of that circumstance as opposed to being taken advantage of by it.
When you say cash rate, just to follow up, do you mean cash, like hard dollar bills, or do you talk about
No,
bonds, bills,
no.
things like that?
Cash to me is certificates of deposit, money market funds, very short term US government treasury obligations, and gold.
Okay.
I proved to myself in 2010 that gold was liquidity for me because there were a range of asset classes, 2009 and 2010, that I thought were cheaper than gold. And I was able to convince myself to part with it and buy those. It was tough. It was absolutely tough. But I proved to myself that my gold was, in fact, liquidity. Many people that I know who have the same philosophical predisposition to gold that I have a problem with it as liquidity because they refuse to sell. And I do not suffer from that sin.
No, fantastic. Rick, I want to touch on oil and gas real quick. We got about like 5 minutes left in the conversation, and it was a tremendous conversation so far. But I want to talk oil and gas because you got in at the right time. The question is, of course, what's your scenario now? Like, what's your exit strategy? When are you selling?
I don't have one, Kai, and I should. I came into the resource business and the oil and gas business, so I've been around it for a very, very long time, and I'm actually more comfortable in oil and gas than I am in mining. I came into the oil business. I came in and increased my positions in oil and gas because oil and gas once again was hated, because $60 a barrel was an unsustainably low price, and because the oil and gas industry was deferring about $1 billion a day in sustaining capital investment. And I knew from past experience that the deferral of $365 billion in sustaining capital a year meant that 2 or 3 years out, production would decline and oil and gas would have to be rationed by price. I had no idea that the world would be stupid enough to go to war again, but the world was that stupid. And the consequence is that the oil prices that I thought I would see in 2029, I saw in 2026. Which leads me to today. What should I do? The rational part of Rick Rule, most of him, suggests that my more recent purchases in oil and gas should be sold because my 3-year objectives were reached in 3 months. The greedy part of Rick Rule, that part which seldom surfaces, is, however, fairly close to the surface, both because any price decline that I see, I think will be temporary, which is to say, I think we'll see these prices again in 2029, 2030. But also because the price increases that we've seen, and your audience will have to listen closely to this, the price increases that we have seen thus far are not price signals that come due to absence of oil, but rather to the anticipation of the absence of oil. The world has been living for the last 3 or 4 weeks on floating inventory and strategic stockpiles. If this war goes on for another 2 or 3 weeks, we will be experiencing in many parts of the world real, not anticipatory shocks. And the oil price there will be a function of the fact that oil will have to be rationed by price. Repeat, the oil price that we're seeing now, the $102 indication on WTI, is predictive. It's based on the eminence of shortage. The price disparities in real shortage will be higher. An example would be right now, Omani crude loaded on a tanker south of the Straits of Hormuz that can be sold is selling at WTI plus $40 premium. So while the futures market shows $1.02, the FOB price for real inventory, not paper inventory. Remember, you can't burn computer blips, but rather real oil is selling for closer to 142 than 102. If this circumstance continues for not too much longer, you'll see a real oil shock. So I haven't been as aggressive selling my oil equities, particularly the basket of small Canadian equities that I bought 6 months ago, uh, as I normally would be.
Rick, we're about 3 months away from your conference, or pretty much exactly 3 months away from your conference, and I'm really looking forward to attending again. I missed last year, unfortunately. But what will be the main themes this year? What do you expect people to talk about the most?
I think the most popular theme will be what I see as the inevitability of higher nominal gold prices. You and I have talked, Kai, but we will demonstrate it with big picture thinkers much smarter than I, that uh, the purchasing power of the world's reserve currency, the US dollar, will decline substantially over 10 years. I've been saying 75%. My belief is if the US dollar declines 75% in purchasing power, that gold will maintain its purchasing power. So, at least in the nominal context, I expect the next 10 years to be very good for the gold price. That isn't to say that there won't be cyclical declines, that there won't be fluctuations in the price. But I believe roughly that gold will hold its purchasing power, while the dollar will lose 75% of its. For speculators, I think over time, silver and the silver stocks will do better. I also believe, for reasons that we'll go into, that copper will need to be rationed by price, beginning sometime around the end of this decade. We will show at the conference that the world has underinvested in copper exploration, construction, production for 30 years. And there is literally nothing that we can do over the next 5 years that will change that picture. There is nothing I can see on the horizon save a synchronized global depression, not recession, that will balance copper supply and demand other than rationing copper by price. What that means is that the high quality, long lived copper deposits already in production, ones that don't need to be discovered, they don't need to be permitted, they don't need to be financed, are worth a lot more than the market thinks it is. It also means that high quality discoveries, we haven't discovered much copper, by the way, because we haven't spent much money looking. But now that we're spending money looking for copper, we're going to find some. And those odd high quality discoveries that are made are going to be sold for absolutely eye popping premiums. And we'll learn about that. We will learn about 3 or 4 tier one deposits in less well known commodities in parts of the world that the market hates, which I'm very attracted to, as you know. And we will talk about one unsung sector of the oil and gas business, which is small market cap companies doing conventional, non shale based exploration, generally offshore and generally in frontier markets, the last unloved sector of the energy business. importantly, Kai, we have a progression of education, educational values at the conference. We begin by wonderful big picture macro people telling you the way the world is, not the way the CBC or the BBC or Fox would like you to believe it is. We go from there to analysts and portfolio managers who have made money in precious metals and natural resources for 40 years. Not people who've made their reputation in the last 12 months of a bull market, but people who have made and defended profits through good markets and bad for 40 years. That's critically important. You know, Kai, from past attendance, that every public company exhibitor at our conference has been vetted. They must be owned in the organizer's accounts or they're not permitted on the floor. At most conferences, the qualification for admission is a check that cashes. Our qualifications are much, much, much stiffer. All of that comes together in two ways. The first is whether you attend live. I shouldn't offer that anymore. The conference is sold out live. But if you decide to attend either live or online, uh, first of all, we'll give you much more content in 4 days than you can absorb. So you'll have access to the recordings for a full year, and you'll need them. And in addition to that, anybody who pays to attend my conference that doesn't think that they got more than their money's worth can get their money back. All you have to do is email me.